Why hello there, my name is Arnold and this is my equities report. For my report, I chose the oil and gas industry. In the oil and gas industry, I chose Spectra Energy Partners LP as my company I wish to examine. In this report, we are going to look at the financial ratios of the company and another indicator of financial stability. The financial ratios are as follows: the liquidity ratio, long-term solvency ratio, asset management ratio, profitability ratio, and market ratio. The other indicator that we are going to look at is economic value added. All of these things are going to be examined to say how good a company's stock is for investors to purchase. The first category of financial ratios that we are going to review are the liquidity ratios. In the liquidity ratio category, we have the cash ratio, current ratio, and quick ratio. Now, the cash ratio measures how much cash a company has on hand compared to its current liabilities. The current ratio includes all current assets compared to its current liabilities. And the quick ratio compares current assets minus inventory to its current liabilities. Of these three, I chose the quick ratio. The reason why I chose the quick ratio to depict this is that the quick ratio does not include a company's inventory. Inventory can be seen as a non-liquid current asset. So this is the best way to depict if a company can meet its current obligations within a year. Now, Spectra Energy Partners did not have the industry's best quick ratios, or current ratios for that matter, but they were the second best. This shows that Spectra Energy Partners could partially cover their current liabilities for each year. The next category of ratios are the long-term debt ratios. These ratios determine the capital structure of a firm, or the mix of debt and equity a company uses to finance its activities. The two primary ratios used in the long-term debt category are the financial leverage ratio and the times interest earned ratio. The financial leverage ratio is more commonly known as the debt to equity ratio. This calculates how much debt a company is using to finance its activities in relation to the amount of shareholder equity used to do the same. Investors are more comfortable with lower financial leverage ratios due to shareholders being residual claimants, meaning that if a company goes out of business, they do not get paid. The other primary solvency ratio is the time interest earned ratio. This ratio determines whether a company can afford interest payments to its creditors. While both of these ratios are very important to investors, determining the capital structure of a company is a high priority for a firm. The company which had the lowest financial ratios in the oil and gas industry was Spectra Energy Partners LP. This means that this company used the least amount of debt in relation to its equity throughout the given time period. The third category of ratios is the asset utilization ratios. This is also known as asset management ratios. In this category, we only have one ratio, which is asset turnover. Asset turnover is gross revenue divided by total assets. In other words, this is calculating how much revenue is made from the assets that are being used. Now, in the asset turnover department, Spectra Energy Partners had the worst of the four companies examined in the oil and gas industry. This was definitely a dark spot on the company. However, there are other redeeming qualities that make this company attractive to investors. We now need to take a close look at the profitability ratios. The ratios within the profitability category are profit margin, return on assets, and return on common equity. Common equity can be broken down into three different categories that can tell you what is driving the numbers. First, we're going to look at the profit margin. Profit margin is basically saying what percent of sales turns into profits. As you can see, Spectra Energy Partners have posted solid profit margin numbers over the last 5 years. This is a positive sign. Next one is return on assets. Return on assets, unlike the asset turnover ratio, return on assets is net income over total assets. So how much net income is being produced by all assets. These are the numbers over the 5 years for return on assets. These are also solid numbers taking into consideration the industry. The final profitability ratio which investors use is return on equity. As we all know, the primary goal of management is to maximize shareholder wealth. Return on equity is a good tool to determine how well management is performing in that task. A high return on equity shows how much profits are being made compared to how much equity is used to finance operations. Return on equity can be broken down into three pieces: the profit margin, total asset turnover, and the equity multiplier. Now, we need to be careful here because if a company has a high return on equity, however, while its equity multiplier is high, then investors tend to shy away from companies due to risks involved with high debt. While Spectra Energy Partners doesn't have the highest return on equity in the industry out of the 4 companies being examined, it does have the highest return on equity with the lowest debt. So this is the main indicator of why investors would be attracted to Spectra rather than the other company with a higher return on equity but still with more debt. The last subset of financial ratios are the market value ratios. Price to earnings and price to book ratios are the two that will be emphasized. The company with the most attractive price to earning ratios is Spectra. This is because it is good to have high price to earnings ratios, but not too high. This company demonstrates a sweet spot for where those ratios should be. Now, the second ratios is the price to book ratios. This measures the price the market is willing to give a company for its stock in relation to the book value of its debt and equity. These numbers were solid, but they were not the best in the industry, but this is okay due to the price to earnings ratio being more important. One indicator of financial well-being is economic value added. Economic value added is what is earned past what is due to creditors and shareholders. How much more did you create past what you must create? Now, unfortunately, Spectra entered in a rough time around this area, but there is hope in the future given that its return on equity and its other financial ratios that this will improve in the future. After careful consideration, as an investor, I would choose to invest in Spectra Energy Partners. This is due to its low financial leverage and its good profitability ratios. These are the driving factors to a successful company, and this is the stock that I believe has the most potential to grow and to earn me money as an investor.